Ladies and gentlemen, boys and girls, welcome to FinFluential Media. If you're new here, my name is Chase. This is actually my second channel. I have two of them, but today we're going to talk about stocks and the financial markets. And well, guys, it has been a crazy day. Are there any bulls left in the chat? If there are, let me know, because it seems like all the bulls have all but disappeared. Another red day for the S&P 500. And today we're going to talk about why, and it has to do with this man right here, Donald Trump, and his vision for America. The people of America gave him a mandate. He's trying to enact it. But for us investors, what does that mean for us, okay, who have money in the markets, who have a lot of their net worth tied to the markets? And how do we play the overall momentum? Is it best to get into the Magnificent Seven, or is it best to get into these individual smaller names? We will talk about it. We will talk about Trump's economy, his second term versus his first term. We'll talk about some high net worth individuals and what they think of this economy, guys. And we'll also talk about Tesla. Are they a buy, or should you sell them? Tesla being down 48% since its peak in December. We're going to talk about all of that and more. But before we get into it, please go ahead and subscribe to FinFluential Media. We only have 300 subscribers, 357 subscribers, and it's imperative for small channels to grow. So please subscribe, guys. I don't have anything to sell you. I have no course, no software, no email list. Just subscribe to this YouTube channel. If you don't want to subscribe, hit the like button, okay? Or leave a comment, or just watch this video, or just give me a thumbs up in front of your screen. But let's get into it. The S&P 500 down 1% today. By the time this video uploaded, it may even be the pre-market of the next day, but down nearly 1% today. An outsized move in some of the other names. Apple down 2.92% today. Coles and Delta Airlines really took it on the chin. Both of them released their earnings and both had a lot to say about two individual components. Tariffs in terms of what Donald Trump is doing right, as well as the consumer. Both of these companies said they're seeing weakening consumer demand, mostly due to tariffs, and that is why they both issued weak guidance. And you could see Coles took it on the chin in particular, down 24%, but Delta as well, down 7% as well. As a result, gold was up 1.17%. There was a lot of tariff news circulating, and gold is a hedge against any type of uncertainty, inflation, geopolitics. And so that is why gold caught a bit, but there was some outperformance. PayPal was only down 0.26% in comparison to stuff like Apple, stuff like Delta, relatively speaking. However, let's talk about Trump's economy right now. And now I know he's only been in power for 45 days, but this time in his first term, we were actually up very close to mid-single digits. We are now down in the mid-single digits, closer to high single digits. The S&P 500 on a peak-to-trough basis, nearly in correction territory. A correction is a pullback of 10% or more. A deep correction is 15% or more. What we call a bear market or a stock market crash is 20% or more. We are flirting with correction territory right here. And that is because Trump is trying to enact his master plan. Now, the American people did give him a mandate. They voted him in, and he's trying to enact everything he promised. But how does that impact you and me? Let's actually talk about his vision. This is what I believe he's trying to do. Now, I may be wrong in trying to believe this, but I think it's pretty accurate. Now, Trump's master plan, okay, what he's trying to implement is three key things, okay? It's a stool with three legs. Think of them as tariffs, cutting income taxes, and then slashing government spending. So there's three P's in this pod, okay? And these three things together to form Trump's master plan. Now, first up, tariffs, right? Now, these aren't just random taxes. They're slapped on imports. They're part of something bigger. Imagine this. I buy LEDs for my greenhouse, right? This week, the prices jumped up 25% because of tariffs. So I call up the CEO of this LED company and I ask, hey, why are they up 25%? And he's like, oh, it has to do with tariffs. And so I'm like, why don't you just make them here? And he's like, that's a great idea. I might just do that. So that is essentially what Donald Trump is trying to do. He's trying to onshore manufacturing back into the US, and that really strengthens the economy. And generally speaking, guys, for every one manufacturing job, you add about 5 ancillary jobs, stuff like grocery stores, cafes, accountants, etc. So, onshoring manufacturing to your company is very, very good for the economy, specifically the county where that manufacturing plant is being implemented or where that business is going to be set up. And when importing gets pricey, guys, companies start thinking, maybe I should just make it here. It might actually be cheaper. It might be the same price. And that way I can say it's made in America and also reap some of the benefits or some of the tax cuts, which is part 2 of Trump's policies. Suddenly, when you do that, it makes sense to produce stuff here. Textiles, metals, cars, you name it, right here in America. It's not just about saving a few bucks. It's about securing the supply chain and also creating jobs. It has a multi-pronged effect. Without tariffs, industries will always chase the lowest cost, and the lowest cost is overseas in places like China, in places like India. With tariffs, you bring production back, and I mean there's 100,000 examples of very similar stuff. Now let's talk about the second wheel in the spoke. So number 1 is tariff. The second thing is cutting taxes, specifically income taxes. In fact, both personal and corporate taxes, just taxes as a whole. This is huge because by doing this, you unleash capital into the markets. If you're not handing over as much to the government, that money is freed up to flow into other opportunities that could be given back to investors, that could be reinvested into the business. There is tons of ways that this capital can be put back into the economy. Suddenly, it's worth it to start a factory because now you have lower taxes and you're not paying any tariffs. You hire workers and you have greater control of your supply chain here in America. And this is also a wild idea I've been thinking about that I think Trump's team is also thinking about. If the Trump administration and the government as a whole move away from taxing income and rather taxing consumption, tariffs are kind of like a consumption tax. You pay when you buy, not when you earn. And as a result, people are going to be more incentivized to earn more. And that's really good for the economy. Some people say that's actually a far better way to tax, and it could actually supercharge the economy by pushing money into production instead of bureaucracy. Now, I'm no economist, but I'd love to see an experiment like this pan out. Now, the last leg of the stool, number 3, is actually cutting government spending. The government is a massive part of the economy, representing 30% of GDP. But if you shrink that and move workers into the private sector, a more productive part of economy, as tariffs bring industry back and tax cuts sparks investment, you'll need people to fill those jobs. And by reducing government, you free people up to move into those higher productive industries. Generally speaking, the government has a negative return on invested capital. In other words, every single year, for every dollar they spend, they have to spend an additional amount to maintain that dollar figure, to maintain that employee, to maintain that infrastructure. Whereas in the private sector, return on capital is actually positive. So that investment they make keeps making money into perpetuity, and it can keep making money in the very, very long run. Also, a leaner government workforce will also offset inflation. Tariffs might drive prices up ever so slightly, but it actually just might be a one-time hit to the overall price. And also, less government spending might pull money out of circulation, and that actually might balance out the overall effects of inflation. Balancing things out, it's like a dance, and the Trump administration is trying to thread the needle. So that is my grand master theory of what I think Trump is trying to do. He's trying to impose tariffs by taxing consumption, reducing government spending, and then decreasing taxes. And something I forgot to say, by also decreasing regulation as a whole. Now, the question is, can Trump do that? I don't know. We'll see if it pans out. But in the year and out, the market not really liking a lot of the rhetoric they've seen. We can see that because the S&P 500 is down 7%. Some of the biggest and high net worth individuals in the world have also lost a lot of money. The most notable here, Elon Musk. His net worth fell $132 billion, but he is still the world's richest man by a wide margin. He actually lost $29 billion on Wednesday. That's absolutely crazy. Now, you can see that a lot of the names here, Elon Musk, Jeff Bezos, Mark Zuckerberg, Larry Ellison, Bill Gates, Warren Buffett, Larry Page, Sergey Brin. These are Google founders. These are the Microsoft founders, right? Mark Zuckerberg is the CEO of Meta, Amazon for Jeff Bezos, Tesla, SpaceX, the Boring Company, Elon Musk. These are like the magnificent 7 sectors, the magnificent 7 companies. And this is what their valuations look like right now. A lot of them look pretty reasonable. Look at Nvidia trading at 23 times, Meta at 23 times as well, Google trading at 18 times, Amazon and Microsoft trading at 27 times, Tesla really out there trading at 80 times earnings. Now, are these stocks a buy? Well, according to Morningstar's equity research, the only stock that's not a buy right here is actually just Apple. If you have a look at Apple, right, they're trading 14 times above their fair value. They're only a 2-star rated stock. So trading at 14 times above fair value, that's pretty pricey. Compare that to Meta, which is trading at 22 times below fair value. Nvidia, 18 times below fair value. If you actually have a look at Amazon, 19 times below fair value. Alphabet, 30% below its estimate of fair value. That is absolutely crazy. Even Tesla trading 11% below Morningstar's estimate of fair value, down 44% year to date. Meta is the only positive one in the group, up 2% on the year. And a lot of these stocks have taken it on the chin. Nvidia down 20%, but actually from its high, it's down very close to 30%. Now let's actually go ahead and talk about Tesla and Elon Musk, because Elon Musk is a big part of this administration. And Morgan Stanley have a note right here. They say Tesla is officially below the election price. They're asking the question, do we go to $200 from where we are right now to $800? Tesla's last trading price was $220. So they say we might actually fall another 10%. And then from there, we rocket up to $800. Now, Tesla shares have fallen 50% from the December 17th high, 45% year to date on poor sales data, negative brand sentiment, and market degrossing. We see the pullback as a buying opportunity for the embodied AI compounder. The catalyst is what we're really interested in. And there are a number of events that we would pay attention to, says Goldman Sachs. The Austin Robotaxi unveil, expected between June and August, would mark the first commercial self-driverless cars. Related to this milestone would also be a pull forward of updated federal rulemaking around autonomous vehicle technologies. An AI humanoid robot day demonstrating the latest capabilities of Optimus is something we expect before year end. There are other technological and commercial milestones that we expect will matter for the stock in the next 12 months. So there is a number of catalysts, including earnings and that type of stuff. Tesla released their vehicle numbers every single month. And then valuation. The pullback of the stock has brought Tesla to a 19 times financial year 30 PE. So they see the stock at 30 times based on 2030's earnings, which is 10 times EV to EBITDA. Tesla is our top pick in the US auto industry, given our expectations for earnings growth, I think, relative to valuation. So looking at like 5 years from now, trading at a 30 times PE still looks relatively expensive. However, this stock does not trade on valuation. It really just trades on sentiment and the long run, 10 years, 20 years out. What is the total addressable markets for stuff like robots, solar, autonomous vehicles? And Tesla is in the driver's seat. No pun intended. At least Morgan Stanley thinks so. But guys, that is it for today's video. If you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, and leave a comment for the algorithm. Cheers.